For that. Well, we have with us Gautam Duggad, Head of Research Institutional Equities at Motilal Oswal Financial Services. Gautam, thanks so much for joining in. Great to have you in. You know, and having you on the conversation also usually tells us it's the end of the reporting season. So it's a fantastic time. Earnings are done. And you know what, just going by anecdotal evidence, and Ekta was just kind of adding to that, right? We've had a fair amount of pleasant earnings surprises this time. So you tell us, how is the tally looking like? And, you know, where are we with respect to the Motilal universe, with respect to the Nifty? And are we on track for at least 12% plus earnings growth this year?
Hi, Sobi. Good afternoon. Thanks for having me. So look, this was a very interesting quarter. You know, if you just go by headline numbers, they are a bit more deceiving. And if you look at the aggregates, they give you a very different picture. And when you basically dig down a little bit, you get a very different picture. Plus, different cohorts and different sectors have performed in a very divergent fashion. So on a very broad basis for our coverage, we have seen about 12% earnings growth for the quarter, which was in line with the 9-10% that we were expecting. Obviously, bolstered by some of these global cyclicals like metals and OMCs. If you strip out the metals and oil and gas, the growth is somewhere about 6%, which is again in line. Nifty is slightly tricky this quarter because some of the cyclicals have had a very turbulent quarter. So you looked at Tata Motor numbers, which came a few days back. There was loss in Indigo, which is now part of the Nifty. And even companies like Coal India and all have disappointed. So if you look at Nifty earnings, they were very flat, just about 2% growth versus expectation of 5%. But the interesting thing is if you look at our coverage universe and then look at the large, mid and small cap cohorts, the mid-caps have really outperformed once again, and the extent of outperformance is just expanding. This is now the sixth quarter where mid-cap growth has been more than 2x of large-cap growth. So if I look at my coverage of 97 mid-cap companies, they've reported a 34% earnings growth, which is slightly ahead of the 23% that we were expecting. And even if we were to remove the solitary OMC, which is there in mid-cap, which is HPCL, the growth is somewhere close to 25%, which is also ahead of expectations. Large cap was fairly okay, in line at about 10% growth. The disappointing performance came really from the small caps. So our coverage of about 142 small cap companies, they reported a 5% earnings decline, largely dragged by financials, which has been a pain point for both large caps as well as mid caps, especially banks, not the NBFCs. So if I look at small cap except bank, the growth is about 10%. Now, the second interesting conclusion from this quarter is there is a big relief because we've seen 4 or 5 quarters of earnings downgrade. This quarter, we have actually seen a very modest 0.5 to 1% upgrade for Nifty EPS and about 2.5% earnings upgrade for our entire coverage universe put together, which is largely led by mid-caps as we discussed. Mid-caps have had a 4% earnings upgrade, large caps close to 2%, and small caps have seen an earnings downgrade about 4 to 5%. So all in all, mid-caps continue to stand very tall, and which is also reflected in a way we've raised the weights of mid-cap in our model portfolio over the last 6 months by about 1,000 basis points. So that's how we are positioned now. On a full year basis, we are expecting about 9% Nifty EPS growth for this year, followed by close to 14-15% growth in FY27.
Okay, 14-15% growth in FY27. Gautam, hi, good afternoon. Just coming to you, and we will pick up on some of these details. We've got a story which we want to put out for our viewers as well. So today is the last day for submissions to the discussion paper which SEBI had put out with regards to mutual funds and asking mutual funds to lower their total expense ratio. There were, of course, also proposals with regards to commissions that they were paying out to brokers. And the discussion paper said, well, it should be brought down to about 2 basis points. So what we understand is AMFI is likely to submit its suggestions with regards to SEBI's discussion paper. And Yash is picking up some of the details of what could be in that response and feedback. Yash, over to you.
Well, that's correct, Prashant. It is the last day when it comes to a submission of stakeholder views on SEBI's consultation paper, which had proposed reduction in the total expense ratio, essentially the expenses which mutual funds make to sell different kinds of funds. What we've been given to understand is the Association of Mutual Funds in India, that is AMFI, is expected to submit its suggestion, the industry suggestions with market regulator SEBI on that consultation paper today. And there are 2 to 3 important suggestions which are expected to be a part of that compilation from AMFI which we picked up. The first one is that AMFI is expected to express reservation with respect to the kind of and the quantum of cut which SEBI is proposed as far as its consultation paper on TER is concerned. What AMFI believes is that the 1.2% or 120 basis points gap in the total expenses which SEBI has proposed for large mutual funds as against the entry of the small mutual funds is too wide. This provides significant disadvantage to large players when it comes to the expenses that they can make versus the expenses which small or entry level funds can make. Here, what mutual funds are expected to argue is that this would hamper the new fund offers from the large mutual funds as well as the distribution strength and may impact, circulation of mutual funds in tier 2, tier 3 areas as well. Apart from that, AMFI is likely to seek a more gradual TER revision once the fund size increases. They feel that the current revision as the TERs come down is very steep at this point of time. AMFI is also likely to propose the TER cap should start from 2,000 crore onwards and not from 500 crore. These are 3 most important suggestions. Apart from that, one that you mentioned, the brokerage of 2 basis points, AMFI is not particularly happy about that. According to them, it's too low and should be higher.
Okay, so let's see what all of this consultation yields on that all-important aspect of capping brokerage costs at just 2 basis points. And also remember that 5 basis points additional that these mutual funds could charge in lieu of exit loads being taken away. So those are some of the sticky points. And of course, TER, the industry has made its demand. It's now up for the regulator to decide. Gautam, we're coming back to earnings in just a second, but since we kind of digressed into mutual funds and capital markets, this discussion paper, when it came out, I think 2-3 weeks back, right, it caused such a flutter. Wealth management stocks, broking stocks, all stocks, obviously mutual fund stocks, all of them had crashed, fearing that what happens if, you put the cap at just 2 basis points, what happens to, local sell-side research. Just your thoughts on, since then, prices have recovered to an extent, but what part of the space are you still bullish on in terms of valuation as well as growth prospects?
Absolutely. We are very bullish on the entire capital market space, whether it is AMC, wealth managers, brokers, exchanges. I know there are a lot of regulatory upheavals which will come along the way, and this industry has been used to it for the last few years. We have seen so many changes in the last 5 years insofar as regulations of capital market related subsectors are concerned. So there's nothing new to it. I'm sure some clarity will emerge as we move forward. Representations are made and discussions are held. But, let that not cloud the long-term opportunity which is present in this space. In fact, within BFSI, we are most bullish on the capital market space.
Okay, so capital markets it is. And yes, that's been a long-standing call, obviously. We know that. It's been on for many, many quarters now, that bullishness. Okay, getting back to your estimate about this year being a year of double-digit growth. So I'm looking through your note. I think it's OMCs, telecom, metals, technology, NBFCs, even cement. These have been the big drivers in Q2. But, talking about the second half, where will the growth impetus really come from? Consumption, capex, where?
So, Subhi, look, insofar as Nifty is concerned, the first half we have seen 5% growth. Second half, we are expecting some pickup on a low base of last year, plus a lot of actions that the government and RBI have taken insofar as income tax reduction is concerned, interest rate reduction is concerned, and now the GST cuts that we have seen. We think the positive effects of all these actions cumulatively will start manifesting in second half, which is why we are penciling in about 14% kind of growth in Nifty for second half and about 15% growth for our coverage universe in second half. So that makes it a full year 9-10% growth for Nifty with an EPS of around close to 1110 and 15% growth for our coverage universe as well. Sectors that are going to lead it are unfortunately the same one. There's not much change that we've been seeing in FY25-26 as well. That larger sectors with huge weight in the benchmark, which is banks, IT, consumer, and Reliance, they've been a bit of a laggard. If you look at the full year also last year and the first half of FY26 as well. In fact, this quarter also, we have seen a decline in earnings of both a private and PSU bank, or maybe flattish for private and about 4 to 5% decline for PSU. Now, the point is, banking as a space, which has been the flag bearer of corporate earnings revival from FY20 to 25, and just to put some numbers on the table, we've seen the profit pool of our banking universe, which is BFSI, if you include NBFCs as well, has gone from 50,000 crores in 2018 to 5 lakh crores in 2025. Now, on that 10x rise, they are now consolidating because the incremental tailwind on asset quality is limited. Your NIMs have seen a big contraction in the last 4-5 quarters. Even if they were to stabilize and move 5-10 basis points higher from here, we're still talking about just about 10-12% kind of a growth for banking, which is a big part of the index. Almost 30% is bank, and if you put together all the weights, then BFSI is close to 37-38%. Large cap IT is also flatlined with about 4 to 5% growth. Large cap consumer staples, the likes of Lever, ITC, Nestle, they're also growing in that 4-5% band insofar as earnings concerned. And therefore, if you look at the index composition for Nifty, roughly 60% of the index is growing at 5 to 7% kind of a growth. If I were to add up Reliance, it will make up almost 70%. So index is having a very tough time because the growth is being lifted by sectors which have a very small representation in the index. So likes of cement, capital goods, metals, telecom, and all of that. So till the time you don't see big weight sectors firing at an index level, to expect beyond 12-13% growth will be a bit of a stretch. So real opportunity, I think, insofar as earnings are concerned, lies in non-benchmark, non-index stocks, which is where I've been highlighting that midcap is where you have a pool where you can still find enough stocks growing upwards of 20-25%.
Okay, all right, Gautam, always good to hear your thoughts. Thanks a lot for stopping by and filling us in with your views. Wishing you a good remainder of the day, and we'll chat up soon. By the way, from the broader markets, just pull up one stock, Fine Labs. I think that stock should come up for you in the screen. Suddenly, it's seen a bit of a downtick. It was trading in the green, I recall. That suddenly moved into the red, and Sagility is the other one. Both of them have fallen off the cliff just in the last few minutes. Well, time to take a break. Come back. Helios Mutual Funds, Dinshaw Irani is waiting for us.